Welcome to Macro Hive Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. So greetings, Phil. It's great to have you back on the podcast. I always look forward to our conversations. And as you and as well as our listeners know, I'm a huge fan of your work. And so I always enjoy every opportunity I can get to speak to you.
Great. Well, nice to see you again, Bilal.
Great. Well, I thought we'd jump straight into it. Inflation. A year or so ago, it was all about transitory inflation, big debates around, how fast will it dip? Is it going to spread and so on? Now we're at a level of inflation where it seems like the transitory debate's gone. Now it's just a question of, it's shifted away from is inflation transitory or not? It's more about how much will central banks hike now? We've kind of moved to that sort of level now. So will it be 2, 3, 4 hikes or 8, 9, 10 hikes? It's shifted to that sort of stage. So let's go through each part of that. On the transitory side, so what's your current view of inflation and the transitory debate? Let's kind of just get that out of the way first.
Yeah, well, I think my model of inflation, to the extent I can call it that, is that it's one of these processes that, and again, this is going to sound a bit pretentious, it's very non-linear. And all I mean by that is every now and then we ignite something really bad. It's a bit like a sort of every now and then you get a bad fire, and the fire comes, the inflation fire comes when we essentially kind of mix conditions together. And specifically, we have a lot of goods price inflation, which I always think of as the sort of combustion to an inflation process. And then we combine that goods price inflation with the rest of the economy, the service sector, let's call it, in sort of tight conditions. So that ignition finds some fuel elsewhere to begin to sort of burn an inflation process. And then the final piece, as it were, is that it then translates into expectations. So in a sort of pre-fire environment, expectations are stable because everyone's got used to low inflation. And then all of a sudden this combustion occurs and everyone panics and runs for the doors and begins to expect more inflation. And that's, I think that's the process we've been through. And it's the first time we've been through that process since basically the early 1970s. We've had a few false alarms along the way, and they always occur in the early stage of a recovery. And one false alarm we had was in '94. I remember that well, when everyone was freaking out about goods price inflation, and the Fed was very aggressive, at least in relative terms, very, very aggressive, and it worked to stall the inflation process. It put the fire out. And then we had another one in 2010. After the financial crisis. This time, however, the Fed didn't need to do anything because there was no fuel there. The rest of the combustion in the goods sector didn't spread because there was no fuel in the rest of the economy. The rest of the economy was still flat on its back after the financial crisis. And best illustration of that is look at unemployment rates in that period and compare the unemployment rate then, 18 to 24 months after the end of the US recession, compare that to where it is now. And that's the biggest difference today versus, as I say, the last recovery. But it's that the way I think about the inflation process is there's no inevitability to anything. It all depends. And the conditions we've had that have developed over the past year have given us a persistent inflation.
Yeah, and you've been great in calling this, recognizing this process and calling for, high inflation. Every time people were doubting, you kept in your notes, kept telling us or telling me, it's here, it's going to come, everyone's going to be shocked, by how persistent this is. And you've been right. So what types of numbers are we looking at for this year and next year, say for the US on, headline inflation, say?
Well, just to be, make sure that there's no misunderstanding of my ability to do forecasting. Every now and then, a blind squirrel finds a nut. Sort of thing. And I must confess, throughout my career, I've probably made systematically more inflation overshoot forecasts that I've got it right. So I need to give that little health warning. But but I think the sort of rates that I'm looking at, we've obviously got, if I go back to my sort of combustion model, we've got this incredible amount of fire that's been burning through March. So 8, 9, even 10% possibly in the UK in the next month or two. That's not the true inflation rate. But I think what we've done is we've moved up from sub 2% in most jurisdictions to something now in the, I want to say 3 to 5% range. And I think it depends a little bit on the extent of overheating in the domestic economies. So in the US and Canada, it's probably closer to 5. In Europe, it's probably closer to 3, 3.5 on an underlying basis. But it's not 2 anymore. We're not going back to 2 quickly. We'll go back quite quickly, I think, over the next 12 months to those underlying rates that I was mentioning. So we won't, in Europe, the last, I guess UK will be most spectacular this coming month, and it'll go to 9% or something like that, but it won't stay there for, I don't think anyway. It'll come back down to sort of the 3 to 4% range in the UK, let's say.
And on the Asia side, Japanese inflation's been really quite low. Part of that is kind of mobile phone fees decline, so maybe you exclude that. Even so, it's still low relative to the rest of the world. I guess you could say it's higher relative to Japan's history, so maybe one needs to look at it in that way. And also China's, at least CPI numbers, are quite low as well. I mean, what do you make of that part of the world?
Well, I think there's, one danger is overfitting explanations and all that, but I think the fundamental point there is that expectations have remained, to use that old cliche, well anchored. In Japan, the problems, obviously, they're too anchored. They really want to, they've been chipping away at anchor for years and they haven't been able to move it. But I think in Japan, it's that inflation psychology that's been very difficult to break. And by the way, and I think this is a very important point in my view, it's a good thing that inflation psychology is well anchored. I think one of the huge mistakes that policymakers made over the last couple of years was to think somehow it would be a good idea to get that oil tanker of inflation expectations moving, because I don't think they realized the sort of the implications of making that shift, especially in the global picture, the global environment in which they were doing it, if you see what I mean. But I think on the Asia story more generally, I think it's less of a cyclical picture, if you see what I mean. Asia is inevitably going to get caught up in these global price trends, and all these low core inflation rates we saw in emerging Asia over the past year and a half have now begun to move up appreciably. But they're not, they're going to peaks of 3.5, 4 rather than 8 or 9.
Yeah, and I mean, one of the hesitations I have about, or not hesitation, I should say, one of the things that concerns me about having a view that inflation's going to sort of stay at high-ish levels, not 8%, but say 5%, is that I think one of the reasons we've ended up with, persistent inflation is that COVID has lasted longer than we all thought, So when, I think part of the transitory argument implicit behind that was that COVID's going to end. Vaccines will fix it all, but it's just dragged on and on and on. I mean, now we seem to be kind of coming out of it, at least outside of China, it seems. China still has its sort of lockdown strategy. And so, let's say we are now out of COVID, no more restrictions, nothing like that, then does that, could that lead to an accelerating decline in inflation? So that's one question. And then the other one is, how much of the inflation we're seeing right now is just energy, or commodities. And so, when commodity prices stabilize a bit, everything kind of goes back to normal.
Yeah. No, I think they're both excellent topics. On the first, I think the issue is really, a lot of it comes down to, frankly, to labor markets and the extent to which we're going to see this pass through from higher goods price and now service price inflation into wage inflation. I mean, one of the features of the US of the past year is actually profit margins have widened. So companies have been trying to raise their prices, but workers haven't, in some sense, enjoyed the full benefits of that or been compensated for the price increases. And my somewhat simplistic view of the world, and I am a believer in the Phillips curve, is the chances of that happening go up when you have a 3 handle on the unemployment rate. If you have a 5 or 6 or 7, 8, 9 handle on the unemployment rate, then there's no way that pass through is going to happen. That's why 2010 and 11 were what they were in terms of the inflation moderation. So I think, the tightness, and one of the things that sort of struck me and actually surprised me a bit is how generalized labor market tightness has been across the developed market world. So where you're sitting in the UK, you're looking at unemployment rates. I mean, I frankly expected the UK unemployment, the UK labor market to be a bit weaker in the last part of last year when the wage support scheme was taken away. But when it went, things got stronger. Same happened in Australia earlier in last year. So I think we've got this generalized strength in labor markets. So that's important. On the energy side, I think one of the risks, and this is something that, there's a amusing set of stories about dear old Arthur Burns in the 1970s, who would keep demanding the Fed staff produce an inflation number that was X this and X that, so as to show low inflation. If you take all the price rises out, then look, inflation's low. And the nearest we've come to that is dear old Jerome Powell saying a few weeks ago that we had the wrong sort of inflation, which I thought was quite funny. So I think that the problem with interpreting energy as a sort of something over there that we don't need to worry about is you forget that it's actually the most fundamental product in the economy, and it gets embodied in everything else. And so once energy prices rise, it sets in place a whole set of relative price adjustments that then feed their way through the system, and that's what we know as inflation. And that's why I've got so much sort of focus on comparing, as well as contrasting, but especially comparing the current environment with the early 1970s, because I think I did my economics training in the late 70s and early 80s, and you'd sit there and you'd look back and say, how could these guys have been so stupid? It was so obvious. Why did they let inflation get out of control? Well, frankly, they had exactly the same views as we've had for the last, not necessarily the last 2 years, but the last 5, 7 years. And in particular, there was this bias to treat everything that was negative, that happened that was negative, as a negative demand shock, to not understand that some things that are negative are actually negative supply shocks. And when you have a negative supply shock, which we've now had 2 of, COVID and the war in Ukraine, your desirable policy response is a bit different. The world gets tougher, and therefore being easy and accommodative becomes a little more of a risk.
Yeah, you mentioned the early 70s as a parallel. There's a few kind of important differences, and I just want to get a sense of how important those differences are. One is the level of unionization is much lower today than back then, and if you look at worker company power dynamics, I mean, it's completely skewed, against workers, and today. So does that affect things? And then the other one is, in the early 70s, you also had the breakdown of the Bretton Woods agreement, which kind of led to an expansion of money supply, you could say. So there was a monetary, switch in monetary regime, which I don't think we're really seeing today. So those two things, does it, how much do those two things matter for that parallel to the 70s?
Yeah, no, I think you're dead right. And there's this whole adage that history rhymes rather than repeats itself. And I mean, in that sense, it's dangerous to say, well, this is exactly how we're gonna play out. So I think in a sense, without playing the game of here's what's different and here's similarities too much, I think I would say you're right, the unionization point, the sort of nature of the labor market contest, let's say, has shifted. But of course, the other way of looking at that is it means that the guys who really set the prices are much more powerful. There's this big sort of debate that, hasn't really got going, but I think will keep going in the US about antitrust and its implications for profit margins and price setting. I think I used to have a view that someone like Amazon was deflationary because they would sort of force lower prices on everyone else. But I've come to realize that as they've become a sort of quasi-monopolist, that they're probably going to, maintain their margins. So that's, you could say that's the counter to the union point. Obviously, the other big difference is the stance of policy. I used to think we were running expansionary monetary policy in the 70s, just because we kept rates low. But now, look at what we've been doing, both with interest rates and QE, or now it's going to become QT. But the quantitative easing process, I think, is hard to figure because we've never done it, we've never seen it, so we don't fully understand all of its implications. And then the final point I'd throw out there, which I think is interesting, more specifically in the case of Germany, for example, is that precisely because, when Bretton Woods broke down, it gave the US more inflation, but it gave Germany and Switzerland and a few other European countries less inflation because they were able to appreciate their currency. Now, Germany is stuck in a monetary union with the rest of Europe, and in a very amusing way, in some ways, has the most outrageous inflation rates that we're seeing across the developed world. If you look at German producer prices, they are rising at a rate that we don't see anywhere else outside of an emerging economy. And I'm not just talking about energy, I'm talking about ex-energy. So there's something weird going on in the European relationship that I think is a function of having this new fixing of currencies that we didn't have in the 70s, which is an intra-European inflation issue.
Yeah. And we'll come back to that actually when we talk about the ECB. And just on this point about, you mentioned this earlier about labor market tightness, and we've talked about unions and so on. Why do you think real wages aren't higher, say in the US? Like in obviously nominal terms, wages have picked up, but you would have thought that given labor shortage, given all this demand, real wages should be going up, and profit margins should be going down. Why hasn't that happened? Surely if companies need people, they just pay them more than inflation, and you get them.
Yeah. No, I don't. My only explanation in some sense is lags. It will happen, and obviously in a world where capital is more powerful than labor, you can say, well, maybe they'll just, it'll be the workers who lose out in terms of inability to defend their real earnings in the face of nominal escalation. But I think the one thing that strikes me as pretty amazing about the US is how I don't think anyone really understands where all the workers went. The number of sectors who are struggling. I went to a presentation last night here I'm based in Georgia at the moment, sitting in Georgia, and the guy from the state, the governor's office, talking about the local economy. And he was saying, the problem in Georgia is that they don't have enough truck drivers. And he said when they did a sort of bit of research to understand where the truck drivers went, they basically went to get jobs at the warehouses that they were delivering stuff to.
Okay.
Because most of their interaction is taking stuff in and out of warehouses, and those jobs were not only paying much more than the drivers' jobs. They also got to go home every night, and not have to be on the road. So there's been this sort of, I think, this phenomenon where we've suffered a major erosion in the supply of workers, and I think a lot of it's immigration in the United States, and it's kind of knocked its way through sectors. And I think that just means that increasingly sectors looking to expand or at least maintain their output by hiring workers will have to pull them from somewhere else. So I think that's the game we're going to get into over the next couple of years. So as that goods price inflation process fades away, you get into this kind of wage inflation, wage price catch up, scenario. And I think that's where we are in the process now, just entering that.
Yeah, I mean, the point you make on immigration is interesting. I mean, in some ways, I guess, is it kind of like a Marxist view that foreign labor is kind of the excess sort of supply of labor that capitalists always have, and that was kind of broken because of COVID, or is this like something else?
No, I think, I mean, I wouldn't. I don't know. Been called
I'd frame it provocatively just to see how you'd react.
Yeah. Groucho Marx, perhaps, but not Carl. But, I think that there's a number of supply side things that have gone on in the United States, and one of them is obviously more people retiring. One of them is obviously people who died, and then you've had a great reluctance to participate in some face-to-face sectors and stuff like that. But I think when you kind of look at the system as a whole, and I look at this incredible decline in labor supply growth across many countries, the countries that seem to have seen its greatest switch from high to low are countries that I think have relied on immigrant labor for much of the last sort of 15, 20 years or so. And that's partly the US, probably the UK, but also, for example, Australia. When you look at why the Australian labor market has tightened so fast relative to everyone's expectation, especially the central banks, it's not because they boomed in growth terms or in employment terms. It's just because their labor supply just slumped. The growth in their labor supply slumped, and I think a lot of that in Australia certainly has to do with immigration. And the lack of people coming from, especially from East Asia.
Yeah. And on the sort of broader labor supply issue, there was one whole kind of story, I guess, that was running through, doing the rounds last year about people retiring, early, kind of sort of intentional retiring. But it seems like more recent data suggests that mass resignation hasn't happened. Right. I mean, do you kind of have a view on that, or?
Well, I think, I mean, part of that, a lot of things in economics, thankfully, are endogenous, so the system adjusts. And, I think what was happening, through 2020 and into early 21 was people were retiring because it was, why would I take the risk? And it's such a hassle and all these things. Now, okay, now the wages have gone back up in the area where I was previously working, or there's another job out there that's looks quite attractive, and so I think you should expect. I mean, one of the sort of aspects of the next year and a half in the US, I think, which sort of helps us skirt the recession risk, is I think we'll see a little bit more labor supply response. So we can keep the unemployment rate. We can still have growth, but not have an unemployment rate going to 2% or something like that. We can keep the unemployment rate in the mid to high threes, even as we grow at a steady pace. And I think that'll be, this endogenous response of labor supply. And you mentioned earlier that COVID should be going away. I'm not so sure, but that's clearly fading as an issue affecting decisions and outcomes.
Yeah, and you mentioned the R word, recession, which we haven't mentioned so far. Obviously, there's a lot of focus on the possibility of recession. The yield curve has started to flatten and invert. We have some recession models that use the yield curve as an input, and they're kind of assigning. It's fluctuating a bit, but assigning like a 50% probability of the US recession in the next 12 months. Of course, the yield curve alone isn't, it has its flaws, but there's a lot more talk about this. I mean, what's your take on kind of recessionary sort of dynamics?
Well, I think there's that old Rudy Dornbush adage that, expansions don't die of old age; they're always murdered by the Fed. And, we don't have an old expansion. We have a relatively young expansion, but we are already clearly in late cycle territory, meaning, the unemployment rate is at near historic lows. and the inflation rate's very high. So everything is flashing late cycle. The big thing that isn't positioned late cycle is policy. We have monetary policy still positioned. There's a lot of talk of what's going to get done, and it's increasingly priced into markets. But the positioning of policy is super easy, and what's priced into markets in terms of where we're going takes us from super easy to still easy, if you see what I mean. So my sort of dilemma as I think through this is what I'm seeing both priced into policy and what is likely to happen to policy. Is it going to be enough to murder the expansion? Or is there something out there, that means we only need a little bit of an assistance from the Fed, for the economy to topple over the cliff? All the Fed needs to do is sort of, the body's standing on the edge of the cliff phase, and all the Fed needs to do is just a little bit of a nudge in the back with a 300 basis point rate hike, and everything goes down onto the beach below. Is that where we stand? And I think, sometimes that happens, and it happens when we have a big financial vulnerability. When we have a system that's sort of got itself in a very leveraged fashion, or, there's some sort of weird thing that's gone on that people didn't quite realize. And then all of a sudden it's, oh my God, we've got all this leverage, we've got all these mismatched positions, we've got all this, and that's sort of what happened with Lehman's in 07, 08 and the housing sector. Of course, at that point, policy rates were already 5.5 or whatever they got to. So we also had the Fed with a knife or two, rather than just a little nudge from the elbow. So I'm what I'm consistently doing is asking myself, can I see either enough, brutality from the Fed, or more importantly, perhaps, can I see a sort of crack or two developing? And I have a very hard time doing that. Now, there is one condition that will give us a recession, I think, quite quickly, and that would be another, as it happened in April 2020 or March 2020, another major negative supply dislocation. And the obvious one is Russia turns the taps off on gas. So we don't just have higher energy prices, we have a phenomenon where we just don't have the supply of energy in key parts of the global economy. And if you turned it off in Europe, it would create a panic and a scramble in Asia and the United States. So that would be, if you said there's going to be a recession in the next 12 months, what's going to cause it? That would be it's not going to be the Fed raising rates 300 basis points, or the ECB doing, 100, 150.
And does it matter if the Chinese economy is weak? I mean, does that fit into any of this or not?
Well, that's another very interesting question, and I shouldn't pretend I'm 100% confident my answer to that, because, I think we're a bit like QE. We're in a world where we've not had such an integrated China into the financial and economic system. I think China's been progressively slowing for a long while now, for probably 10 years. So I'm not sure what we're seeing is anything that different. I think it would take a major financial crisis in China to be a big problem. That could be the crack. The credit environment in China could finally blow up. But again, I don't, I'm not a real expert on Chinese financial structures, but I don't see, I think they've built even more buffers and short circuits, or resistance circuits into their system. And in particular, what always gets us in a financial crisis, what always sparks us, is a panic on the part of the creditors. So you end up essentially funding less good long-term assets with increasingly vulnerable short-term funding. One way or another, that's been the generation of every crisis I've ever seen, and that's what I'm not seeing anywhere. I don't see a lot of short-term funding of long-term investments, at
Yeah.
least so far.
And so, we get to the Fed then, and, sort of the most recent hiking cycle, the Fed hiked to, I guess, 2.5%. Before the GFC, we were, 4.5, 5, you could say, was kind of the terminal rate, so to speak.
Yeah.
So where do you think it should get to, and where do you think it will get to?
Well, frankly, back to where we used to be. I think what will happen is we'll see the last expansion as the exception rather than the new rule. And what I mean by that is, aside from the fact that it was kind of cut short by COVID, and we never really will know what would have happened if we played it forward. I happen to think that what would have happened is that what has happened, which is that, inappropriate easing at now what was at the end of the last expansion will have generated higher inflation, and overheating, and we'd have ended up with higher Fed rates and a recession the conventional way, and that higher Fed rate would probably have been somewhere closer to 4%, which is where I think we're going to go over the next sort of 18 to 24 months. I think my view is recession is most likely in 24. Bad news for the president trying to get re-elected. But that's when policy from the Fed will probably be tight enough to create some tensions. And I'm thinking, the Fed funds rate in the 4 to 5% range, and a bond yield that is also at least that high. Because I think what will happen as the Fed tightens is the yield curve will shift in a somewhat parallel fashion. And it kind of just goes back to this idea that, okay, what is there out there that if I said to a business, look, you have to pay a 2 or 3% real rate, well, actually, if it's 4 to 5 on nominal and 300, at least 3 on inflation, then it's less than, it's 1 or 1 and a bit. If you have to pay a 1 and a bit real rate, is that going to cause you to contract your business? And they'll look at you and say, you must be joking. If you can guarantee that to me for the next 10 years, I'm going to expand like crazy. Now, so you have to have something else out there, I think, that's going to come along and whack you to create this major negative environment. It could ease. I think it'll be higher inflation, persistently higher inflation, not higher than where we are today, but just higher than is perceived to be acceptable, forcing the Fed to basically, to use that old English phrase, to squeeze it, until the pips squeak.
I had Dominique Dwarfrico recently on a podcast show, and obviously she, I follow, she's someone who I work with, so I obviously follow her work very closely. But she's been arguing that the Fed could raise rates to like 7 or 8%, because if you look at Taylor, if you just look at any kind of type of metric, I mean, as you know, as an economist, it should be much higher. It should be even higher than the pre-GFC period. So why shouldn't the Fed go to 7-8%?
I don't know. I've been tired of being a wild man on the Fed.
Okay.
Years, so I don't want to sort of go too crazy. I don't mean, I shouldn't say that, but what I mean is, I think we're entering a phase where it pays to think more about how expansions developed pre-2008, 2009, rather than to treat the last one as the rule. That's my basic point. And as Dominique's perfectly correct. If you look at the Taylor rule, did a fantastic job of, in a sense, predicting the Fed. It was, it was almost a rule that they were using implicitly. And it did a great job until, sort of Ben Bernanke took over. I've got a book in me that it's a critique of modern terrible macro policy making, and its working title is called "Blame Ben Bernanke," because
I like it.
He's the influence of his thinking from 2001, 2002 onwards, I think has been very, very, very corrosive on global policy making, on DM policy making.
Yeah, I look forward to that book. I mean, maybe we could help you publish it as well through, so yeah, it'd be quite provocative.
I have to put it under your name, of course.
Oh, okay. So you want to keep your friends at in the policy circles. Actually, just on that, I mean, how important is kind of the personnel at the Fed? You know, because in markets, we all like to kind of talk about, oh, this personality is going to join the board or not joining the board, or this person's influential. I mean, is that helpful, do you think, or is it just the macro conditions are such that it doesn't really matter who's at the helm?
Well, I think the Fed's in real trouble personally, because I think they made a bet on a particular way to think about the economy.
Yeah,
that has been shown to be disastrously wrong. Now, you know, that's the second time they've been disastrously wrong within, you know, 2 cycles. They were disastrously wrong on the financial stuff before the financial crisis. I mean, I would urge everyone, if you want a bit of light time, entertaining afternoon reading, go back and look at some of the speeches that Fed officials made about the US housing market in 2005 and 6 and the mortgage market. It is shockingly bad. And that, you know, in a sense, I think that we're going to look, you can do the same thing, look back at what Fed officials were saying about the inflation outlook for the, you know, much of the last couple of years. And you think, well, if it was any other organization and I keep making such terrible mistakes, you know, that really matter, you know, shouldn't people be losing their jobs and these sorts of things? So you know, I mean, I guess the way I'd think about it is the Fed's sort of become the Manchester United of policy making, you know, and you know, it's time for, I'm not sure who the Louis Van Gaal is, but no, not Louis Van Gaal. What's it? Eric van der Tak or whatever.
Yeah. Tan Hag, yeah.
No, I think Larry Summers is the closest. You know, Larry would be the the closest. But I think they're just in an environment where, you know, because they've kind of got it so wrong, they now have to go somewhat to the other extreme. And I think you have a very amusing sort of thing last week, just before the blackout started. You know, you had 2 of the most dovish individuals, Mary Daly and Charles Evans, giving these incredibly hawkish speeches, and you think, well, where's your consistency? You know, anyway.
And what about the ECB? You know, we've you know, they haven't hiked. I mean, they're still kind of talking about you know, ending APP in Q3, then sometime after raising rates, and there's a debate inside the ECB, some hawks, some doves, but they don't seem to be on the same page as the Fed.
Yeah, no, I mean, I think the ECB is in an even bigger problem, because obviously what's becoming exposed is the sort of the risks of the system they've created, which, you know, they never made the Euro system work perfectly, and it's been held together through the band-aid of negative rates and massive QE. And as that begins to look like it has to be unwound, I think these systemic-wide risks are building again. And you know, the thing that amazes me about the ECB is not that the board in Frankfurt is pushing the line that it keeps pushing, which that's been their sort of structural DNA. It's that the Germans in particular have not created so much more fuss. I mean, I think, you know, I would have expected by now the Bundesbank's new head, Mr. Nagel, to be much more aggressive on the need for rapid policy normalization. But he seems to be willing to sort of go along. I think what's happening behind the scenes is an agreement that we will move in July, and from that point onwards, it's going to be a steady adjustment. I think that's,
so. You say move in July, as in you think they'll hike in July rather than September?
Yes, I think I'm sort of waffling a bit between the two.
Okay.
I think they definitely end the QE program in June, and then, you know, at the June meeting, and then they almost certainly make some kind of announcement in July that says we're either going or we're going to go, you know, because I just feel by that point there'll be enough. Well, first of all, I think we're already hearing it from individuals.
Yeah,
that's going to happen. And I think if they don't, there'll be sufficient pushback from, I wouldn't even call them the hawks, but from the harder money groups in the ECB, that something has to give here.
And I mean,
sorry, go.
I was going to just say, I mean, when I read the ECB speeches and the press conference and everything, I mean, they do seem to think that the Ukraine-Russia conflict is, as well as causing some inflation, is a negative growth shock for them in a way that it's not for, say, the US. So, and I wonder if Germany is particularly worried about that, hence why they're not so hawkish, because it's the whole industrial base in Germany is based on cheap energy from Russia, and so that's been undermined.
I think you're dead right there, that's the explanation why the Bundesbank isn't more hawkish.
Yeah.
But I think, again, that goes back to this discussion of how do you think about a shock like that? Is it a negative demand shock, or is it a negative supply shock? And, one way of thinking about what's going on in Germany is precisely because they've been very prudent on their public finances. They actually now have the ability to be a little more expansionary. So what you're going to get is, higher costs and leftwards in the, the economist's aggregate supply curve at the same time that the policy is going to push the demand curve out. And, Germany is going to have a more persistent inflation problem than even the rest of the Euro area. Let me throw out another idea here, which I think is very important, which is that, I think there's this mentality out there that inflation is negative for growth. I actually think in the near term, it can be very stimulative for growth. And what I mean by that is, if you've got an environment where two things go on, one where you've got big relative price shifts, there's a lot of new incentives for investment. So obviously the energy price increases are a big drag on users of energy, but there's going to be a phenomenal investment program developing globally, including in Europe, to build alternative energy production facilities, whatever they may be. And that's quite similar, dare I say it, to what happened in the later 1970s, when we had an investment boom, particularly in North America, but across the world, that was stimulated by the first oil price shock. So that's one thing. The second thing, which I think is even more important, and it's one of these nerdy things economists like to talk about, I like to talk about, is inventories. We've spent the last 20 years or so trying to keep inventory low because it was like a negative carry position. They just cost you money. The prices went down, they just burn a hole in your pocket. Now, in an inflationary world, or a less deflationary world, let's say, and a world where lots of businesses have found themselves too short of inventory at various points for the last couple of years, I think there's going to be a tremendous tendency, and this is Europe, but also US and globally, tremendous tendency to want to build inventory. So I think we're going to get goods demands much stronger than most people think for the next couple of years as this structural change in inventory takes place.
Yeah, and I wonder what other legacies there are of the pandemic. So for example, what one, as you rightly pointed out, could be higher inventory balances going forward. There's also been this kind of energy shock that's kind of been due to or was happening anyway, and COVID exacerbated it. So there's some sort of shifts around that. I mean, what about other things like people working from home, or, greater use of tech in the service sector? These are the things that we've kind of experienced over the COVID period. I mean, can we draw any conclusions, or is it just too kind of fluffy to kind of pin down?
Well, no, I think you're right. There's lots of things that we'll understand better when we've got more time and more evidence and things. But one way of thinking about it is we've taken the capital stock that we had designated for a particular way of doing economic activity, and we've shaken up economic activity. So we've got a capital stock that's sort of somewhat in the wrong place. One way of thinking about that is depreciation on capital is accelerated. We don't, we've got the wrong stuff. Too many subway systems and too many offices and not enough whatever we need, to service us all at home and stuff like that. And that's I think of that as a consummate supply shock. That's what COVID was in many, many ways. And we're going to kind of live through the implications of that. And of course, you could say Ukraine's another angle to that, because we got used to enjoying the benefits of much lower defense spending, especially in Europe. We could put those resources into more productive things. Now we're going to have to go back to basically buying stuff that when it gets used, all it does is blow something else up. So that, from a capital stock perspective, isn't, an investment in a tank is not a very productive investment, no. From what I can say. So I just feel that, there's lots of things that are happening, which in some ways, the way to think about it, I think, is in the distribution of shocks, global shocks, there is a reasonably sort of symmetric distribution over time. But for about 30 years or 20 years, starting maybe in the early 90s, late 80s, early 90s, we had regular drawings from the positive side of the distribution. We were getting all positive things. And now, in somewhat, biblical fashion, we're getting a set of negative ones that, and then in the policy and markets world, you have to deal with that. You have to recognize that and recognize that those have implications.
Yeah. I mean, what one way I was thinking about this to try to think of it bigger picture was that if you think about the GFC, what happened in the run-up to the GFC was that we, in effect, had this globalized financial system. So it seemed like there's no friction, no inventory in banking capital, everything just worked really sort of lean. And then what the GFC did was it said, actually, no, it's not globalized, it's nationalized. Everything comes back to the national balance sheet. So suddenly you realize, actually, everyone has to come home. The banks, have to come home, and it's more fragmented, and we've had all this regulation ever since. And I think what COVID has done is something similar to the labor markets in terms of labor stock. It was like globalized labor supply, labor stock. Everyone could move around, and it all kind of worked really well. And the gig economy, people could work or not work. But suddenly COVID basically, was a shock to the human stock, labor, human capital, you could say. And so suddenly you don't have this movement of labor across borders, what you touched on earlier, so immigrants on the immigration side, and then the gig economy and so on. So suddenly there's this awareness now that where you live, kind of local labor is quite important. You can't always get people sort of crossing borders and things like that. Anyway, this is just, I don't know, maybe I'm not articulating this that well, but I'm trying to sort of think in terms of making parallels with like shocks to capital or some kind of factor of production, and you have to adapt to the new norm now.
Yeah, absolutely. And I would extend that. I mean, repeat a point I made, but extend that thing by saying, look, post GFC, it was all about greater buffers in the financial system, which is partly regulatory but mainly behavioural, to give myself more protection. And that's, I think, precisely what we're going to see in the broader economy. Let's call it in the real economy. The housing is fascinating because we didn't build many houses around the world for 10 years. We built some, but we didn't build as many as we built. A lot in China, by the way, but that's a different tradable issue. But in most places, so when you think about the impact, going back to this discussion of the effects of Fed tightening or BOE tightening on the economy, housing's the heart of the transmission mechanism always. And you think about, how much effect a point or a point and a half is going to have on housing in, for example, the US. It's much less damaged this time than it did in 05 and 06 and 07, and probably much less damage than it did in even the 90s, because we are just, just to give you a very simple illustration, we're at record lows on home inventory for sale in this country, and 1/3 of houses for sale in this country are new homes. In other words, if you want to buy a new home, you're better off. Sorry, if you want to buy a house, there's 1 in 3 chance it's going to be a new house. Wow. Whereas that relationship is normally something like 1 in 20. but there's just such a shortage of old houses that, you know, you're going to have to produce new ones to meet the demand for housing. You know, there's no, either that or people living, you know, with their parents or in the front yard or something. You know, it's
Yeah.
a shortage.
Yeah. I mean, the other interesting thing I think on the interest rate sensitive side is the auto sector, because normally the other important part of is the auto sector. But this time around, what's happened is there's been auto sector's been dislocated by COVID. So everyone's had to buy used cars rather than new cars and so on. So if you do jack up rates, you don't get that other auto sector transmission either in the same way as you had before.
No, we're going to have, you know, we're going to have people doing some really screwed up regressions over the next couple of years, because they're going to, you know, look at auto sales going up and interest rates going up, and they're going to be saying, "Oh, look, you know, what's the garage?" You know, and then that's welcome to the, you know, the post-COVID world sort of thing.
Yeah.
That's and I think, you know, what none of us know, and I certainly don't, is how businesses will respond over the next couple of years in this world where constraints begin to get eased. So, you know, once you know, the Toyota, etc., BMW, whatever, can start producing the cars that they really want to produce, are we going to peak at, you know, 25 million sales in the US, or are we going to peak at 18? You know, we're currently down at sort of 12, 13. We've been sitting there. You know, in other words, are these sales that didn't happen for the past year, are they permanently gone? Or do we have to get back to a normal run rate of, say, 17, 18, and then some to make up for the sales that
okay, yeah, kind of like an output gap type thing. You know, what is the output gap in that sector? Yeah,
you know,
yeah.
and I think it goes back to this idea that you know, you've got to think about shortages, you know, and you know, an underproduction, not just during the recession and recovery, but for an extended period, that's left us with some pent-up demands, which are very hard to know where they're going to settle. But you do know they give you this, what I would call late cycle strength, at a time you just don't want it. You just don't need it.
Yeah.
Which, again, feeds back into the policy discussion.
Yeah. And just finally on kind of the finance macro stuff, what do you think this all means for equities? Because you could see a scenario where equities are weak, the Fed's hiking, and the economy could be doing okay. I mean, it could just simply be that, you know, stocks were boosted by low rates for a long time, and so you kind of get this decoupling between equities and the economic performance of real versus financial. Or, you know, maybe equities could have a boom. You know, this is a recent, you know, equity consolidation could be temporary, and we could have a boom. I mean, do you have any thoughts on that side?
Well, no, I'm not. You know, put it this way: my macro outlook, I think, is quite negative for equities, because it's all about higher bond yields. And
okay, yeah,
bond yields are the primary sort of basis for equity pricing. You know, so I think that's my main take. But I don't mean that means equities go down for the next year and a half. They bounce around, I'm sure.
Yeah.
But you know, the next short period, the next couple of years is weaker, I think.
Yeah. Now, I did want to ask a couple of personal questions. I always like to end with some personal questions. You know, the first one is, I've asked you before sort of the best ever books you've read, but have you read anything recently? Any, you know, could be articles or books that kind of stood out for you?
Yeah, so here's my confession. I've really got into American history. Well, because you know, we relocated partly to Georgia part-time, and I'm fascinated with the whole issue of sort of how, especially the Southeast developed and all that. So I just finished reading a great book on the French Indian War.
Okay.
Which well, we call it the French Indian War, but it's in Britain known as the 7-Year War. But it's fascinating because that period is really the period, when I think about how much developed globally, it was sort of when Britain came into its own as an imperial power, or tried to, thought it could. And William Pitt was, and we have a stained glass window in our new house of William Pitt, who is, you know, I won't say my new hero, but he's kind of an interesting character. Not Pitt the younger, but Pitt the elder.
Okay, yeah.
Guy who's the guy who promoted all this. But what's amazing to me is how quickly it turned from sort of triumph, which was basically, we take over North America and kick out the French, to within 15 years, or even less than that, 5 years, into the seeds of the American Revolution. So
wow.
it's a
Yeah,
reminder, and I think about that in the context of all these geopolitical changes we're seeing, the ending of the Cold War and Russia and all these things. And it's a kind of reminder that these things they're always with us, these major geopolitical tensions. They've been with us forever, and they'll keep coming with us. So that's
and that book, is it, what's it called, or who's the author? Or yeah, when you you're nice. I'm looking at you go to your nice bookshelves there.
It's called The War That Made America. The War That Made America by Fred Anderson. It's very simple, but and for those of you who live anywhere near Greenwich in London, you've got General Wolfe. The hero who died at Quebec, storming Quebec.
Yeah. Okay, that's great. Yeah, I'll have to look out for this. Now, the other question I want to ask you was, through MacroHive, we have kind of a big kind of exposure, and I often get questions from young students who are about to graduate, and they ask me questions about like, how to get a job at a bank or in finance and all these sorts of things, or advice. So rather than me having to think of my answers, I thought I'd put it on you to have me answers so I can pass on to them. I mean, what advice would you give to youngsters who are leaving uni now? Presumably there'll be like physical in-person, jobs they'll be having after the summer. Any advice you'll kind of give to grads?
Well, I mean, I suppose the obvious one is, which I give to my kids, is be flexible and keep an open mind. I mean, don't go into things with preconceived notions. I guess when I look at the jobs that all my kids do, none of them existed when I was graduating from university, and a lot of that's the advent of technology. So one of the things I think is a little different is, and this is kind of showing that I've become an old man, kids don't seem to want to work quite as much as
Okay, we're going there, are we? Okay, let's do it. There's lazy kids. The music today is terrible. Movies are terrible. Back in my day.
I guess my main advice is see the success of your company, whether it's a big company or small, as part of your success. In other words, don't sort of view work as a hassle. View it as a positive thing that you can by enjoying it and doing well, you'll help your company do well. And then anyway.
I mean, I definitely noticed that for the younger people that work for MacroHive. I mean, there's definitely a sense of they want a sense of like purpose behind the organization. It can't just be a job. There has to be something bigger about the organization they're working for. And then there's also just more, I'm not saying more demanding, but like sort of there's more willingness to ask for things in the job. Like when I was starting, I'd basically almost do whatever the company would tell me to, but this time it's more like, okay, no, I won't do that because of this, or I want to do this because of this. And so it's kind of more of a balanced relationship in some ways.
No, I think the main metric, think like an owner, and which is hard to do starting in your career, because you tend to think like a slave, but don't think like a slave. Think like so that I've got a vested interest in everything going. That's my main tip.
Okay, I like that.
And make sure you look after your old dad. That's my other tip.
Yeah, that's a good one. I like that. Yeah. Don't forget the parents. Now, final thing, I have to talk about football. We're coming to the end of the English Premier League. I know you're a Luton supporter, so maybe I don't think. Well, I mean, forgive me if I say this, but not many people may know what Luton is or what it is. But can you give a bit of background of Luton, the football club, and then what's going on with them in this season?
Well, we are almost certainly, I'm pretty sure, the most cyclical soccer club in the country. So in my viewing lifetime, I started going to the ground in 1968, and we were in the 4th division then, which is now League Two. By the mid-70s, we were up in the 1st division, the Premier League. We went up and down a bit. And then by the mid-2000s, we were down in the conference.
Wow.
You know, we actually dropped out of the Football League to the 5th division. And now we're back in the 2nd, or like the Championship, vying for a spot, maybe even in the Premier League next year if we do well in the playoffs. So I don't think I know of a team that has had so much volatility. It certainly makes for entertaining watching. You know,
so if they do get promoted, if Luton does get promoted to the Premier League, that will be the first time since the 70s they'll be in top flight.
Well, we actually did the magnificent job of being relegated the year before the Premier League was started. So we win the top flight for about a decade, from the early 80s through to the early 90s.
Yeah.
In fact, the absolute peak in Luton's performance, and there may be some Arsenal fans listening, was when we won what I guess is now called the Carabao Cup, the League Cup at Wembley in 1988, beating Arsenal 3-2, which is clearly, you know, the highlight of my life.
Yeah. But, I'll have to excerpt this clip and send it to all my friends who are Arsenal supporters, just to kind of remind them of, you know, some of their past. And I support Liverpool, so obviously Liverpool's doing very well, and there's this tie at the top, Liverpool against Manchester City. I mean, do you have a view on, you know, what's kind of happening at that level?
Well, I have to say, I think the two most impressive business managers in the world, are Pep Guardiola and Jurgen Klopp. I mean, I think they should. I'd like to make one president of Europe and the other president of the United States, and we have a really good, really good system. Because I just think these, you know, what's fascinating to me about soccer management is, you know, it's really got professional, if you see what I mean. Important thing to say, but these guys are very analytical, very thoughtful, and adjust to shocks in a way that unfortunately the Fed and the ECB maybe aren't quite able to. So, you know,
I like that.
Jurgen, the head of the Fed, and Pep, head of the ECB.
Yeah, I could see that. That'd be quite. They'd probably do a better job, to be honest. And then Van Dijk as kind of prime minister or something. He's a really cool customer. You know, you kind of feel very sort of secure and safe with him.
Yeah, no, I love the Man City goalie, Edison. I think he's actually got you know, cold ice running through his veins.
Yeah, he does. Yeah, I wouldn't be. I'd probably cross the road at night if I saw him as well. You know, the statues and all. But yeah, no, it's turning out to be a great season. Well,
luck,
you know,
good luck is all I can say.
Well, with that, I mean, for just for the benefit of our listeners, if people did want to get in touch with you or follow your research, and what's the best way for them to do that?
Very, very simple. I mean, we have SuttleEconomics.com. It's Suttle Economics, all one word, .com, and there's various, you know, entrees through that. Or you can email me at phil@SuttleEconomics.com. So
I'll include all this information on the show notes as well. So so with that, as always, great chatting to you. We kind of talk about everything, anything and everything, which is always fun. So thanks again.
A real pleasure. Thanks, Bilal.
Great.